October 2025, Bitcoin hits $126,000. The ETF era is in full swing. Institutional adoption is real. Everything the bulls predicted is coming true, right? Fast forward 4 months. Bitcoin is now $70,000, down 45%. Bitcoin ETF total assets down $31 billion. 62% of ETF inflows underwater. And every headline is screaming the same thing. Bitcoin isn't digital gold, they say. It's just another risk asset. But here is what nobody is talking about. Bitcoin's fundamentals haven't changed. The 21 million supply cap hasn't changed. The provable scarcity hasn't changed. What changed then? Institutional understanding. And that gap between what Bitcoin is and how institutions are treating it, that's creating one of the biggest opportunities we've seen in years. I'm Jess, and today we're going into the ETF data. Not to prove Bitcoin failed, but to show you exactly why institutional panic is actually bullish for anyone who understands what they're buying. So let's get into it. Okay, so let me show you what's actually happening with the Bitcoin ETFs, because the story everyone's telling is backwards. Since January of 2024, when these ETFs first launched, investors have put in a cumulative net total of about $55.3 billion into Bitcoin ETFs. And that's according to SoSo Value data. And that's after accounting for all the inflows and outflows. Now, the outflows have been real. Between November and December of 2025, we saw $4.57 billion in outflows. And in January this year alone, we saw $1.61 billion leaving in outflows. Yet the worst single day was on January 29th, when we saw $817 million leaving the Bitcoin ETFs. But here's the part everyone's missing. If you do the math, only about $2.5 billion has actually left these ETFs since the peak mid-January. That means about 96% of the money that went into Bitcoin ETFs is still there. So if the money didn't flee, why did ETF total assets crash by $31 billion? And that's because Bitcoin's price fell from a peak of $128 billion in total ETF assets on January 14th down to $97 billion by early February. But here is where it gets really interesting. Bitcoin didn't fall because the fundamentals changed. The supply cap we know is still $21 million. The network didn't break. The scarcity didn't disappear. Bitcoin fell because institutions with risk mandates sold it like it was tech stock. So let me show you the numbers that prove this. Because according to SoSo Value data, 62% of ETF inflows are now underwater. That means 62% of the dollars that came into these ETFs came in at a higher price than where Bitcoin is trading today. And that's the problem. Average ETF cost basis is about $84,000, and Bitcoin today around $70,000. But here's the question. Did Bitcoin fundamentally change between $84,000 and its current $70,000 approximate? No. Did institutional understanding of Bitcoin change? Not really. They never understood it to begin with. That's also the problem. What changed is macro conditions. They triggered their risk-off protocols. That's what happened. And here's why that matters. This isn't a story about Bitcoin failing to be what we all thought it was. This is a story about institutions treating the most provably scarce asset in human history like it's just another position on a Bloomberg terminal. And unfortunately, this issue gets solved with time and education and maturity towards Bitcoin from the institutional investor crowd. If you actually know what Bitcoin is versus how it's being treated, then watching 62% of institutional money go underwater isn't scary. It's opportunity, which is how most of us here at my channel view what's going on in the market. Anyway, here's what most people don't understand about why institutions are selling and why it has nothing to do with Bitcoin's inherent properties. When you sell your Bitcoin ETF shares, here's what can happen. Step one is when these institutional investors decide to sell, for instance, their IBIT or their FBTC shares on their Fidelity or Schwab account, they hit sell and they're out. Then what happens? Well, Big market makers, the authorized participants, they accumulate those shares from the market. Then they take those shares back to BlackRock or Fidelity and say, we want to redeem these. BlackRock in turn gives them Bitcoin in exchange, actual Bitcoin. And then those market makers can sell that Bitcoin on Coinbase, Kraken, or other spot exchanges. So when you see $817 million in outflows, that can translate into Bitcoin being sold on spot exchanges, creating downward pressure on price, which then makes the narrative, see, institutions are abandoning Bitcoin. The digital gold thesis is dead. That's what uneducated Bitcoin investors through these ETFs end up thinking. But that's not what's actually happening. What's actually happening is like this. Institutions have risk mandates. They have drawdown limits. They have compliance officers who ask questions when an asset drops 24% in 3 weeks. And here's the key. Those compliance officers don't understand Bitcoin fully either. I doubt it anyway, or they're not doing a good job at describing Bitcoin's inherent value to their clients, which once again comes with more education, which in turn becomes conviction. In turn, what they see is a volatile asset correlated with tech stocks down 24%, triggering risk protocols. Because in many ways, these Bitcoin ETFs are being grouped in with tech stocks, which are down right now, which I'll cover here later in my video. So these money managers, they don't see a provably scarce monetary asset with unchanged fundamentals experiencing temporary price volatility. So what they do is they sell. Not because Bitcoin changed inherently once again, but because the 21 million cap disappeared. Not because the network broke. They sell because their systems tell them to sell. And here is where the opportunity comes in for you and for me. When institutions sell based on risk protocols instead of fundamental understanding, they create price dislocations. Price drops below intrinsic value. And that's when people who actually understand what they're holding accumulate, like us. So think about it. If you believed Bitcoin was digital gold at $84,000 and nothing about Bitcoin's fundamental properties have changed, why wouldn't you want more at $70,000? You would see it on sale. The only reason you wouldn't do this is if either A, you never really understood what Bitcoin was, or B, you're forced to sell by risk mandates. And most ETF investors, they're in category B. Their money managers are selling for them. Their algorithms are triggering stop losses. Their compliance departments are enforcing drawdown limits. None of that, though, has anything to do with whether Bitcoin is actually digital gold. It just means the price is being set by people who are forced to sell, not by people who understand what they're selling. So let's talk about the macro environment we're in to set and give us some context, because ironically, it's actually proving the digital gold thesis, even though the price action suggests otherwise. It just hasn't caught up yet. So let's take a look at what's happened since January. We know that in early January, Trump executed the military raid in Venezuela. He captured President or dictator Maduro, and now the US is essentially running Venezuela as a vassal state. And Trump has twice threatened military strikes on Iran, and even moved the USS Abraham Lincoln Carrier Group to the Middle East. Next, in regards to the Federal Reserve, we know that rates have held at 3.5 to 3.75%. And markets are pricing in only 2 rate cuts as of now for this year, with the first not until June at earliest, according to the CME FedWatch. Next, we also know that Jerome Powell's term expires in May, and Trump has he's tentatively selected Kevin Warsh to replace him, who's seen as hawkish. Next, we know that Microsoft lost more than $350 billion in market cap on January 29th, which in turn had an effect on the broader software sector, with fears that AI would make traditional SaaS companies obsolete. So over $1 trillion got wiped from tech stocks in a week. And then we know that silver crashed about 28% on February 6th, with gold hitting record highs near $5,600 before reversing. So we saw a scenario where everything started selling off at the same time. But now let us focus on the question everyone's asking incorrectly. And that is this. Okay, this is what people are saying. If Bitcoin is digital gold, why did it fall during all this chaos? But that's the wrong question. A premature question, anyway. The right question framing would be, what should an asset with provable scarcity and no counterparty risk do when governments are literally capturing foreign leaders? Central banks are keeping rates elevated despite pressure. Tech stocks are crashing over productivity fears, and traditional safe havens are volatile. If you believe scarcity has value, if you believe an asset you can verify yourself is better than one you have to trust, because we know we can't verify gold bars are truly 100% gold bars. And if you believe non sovereign money matters when governments are getting more aggressive, then the fundamentals tell us Bitcoin should be going up, right? So why isn't it? And it's not because the fundamentals are wrong. It's because the people who control the price right now, institutional money managers, don't understand the fundamentals yet. They're catching up. So let me show you the difference. Bitcoin is down 45%, gold up 24%, and the dollar strengthening. Everyone's looking at this and saying, see, gold is the real safe haven. Bitcoin failed the test. But think about what gold is. Gold is stored in vaults you can't verify. Gold supply is estimated, not provable. And gold holdings by central banks and governments are trusted, not verified. Bitcoin, on the other hand, is stored on a blockchain. Anyone can audit. Bitcoin's supply is mathematically capped at $21 million, verifiable by anyone at any time. And holdings are provable. They're confirmable through cryptography. So which one is actually more valuable as a store of wealth in a world where trust is breaking down? The one you have to trust or the one you can verify? The answer is obvious for us who understand Bitcoin's intrinsic value. But the institutions don't understand this yet. Not really. There's huge gaps in their knowledge, and that is what we are seeing right now. It's being demonstrated in real time. Institutions are selling their Bitcoin and buying gold because A, gold is in their traditional risk-off playbook. It's very common knowledge to them. B, their compliance departments understand gold, as I was saying, and their systems treat Bitcoin like tech stocks. And none of those reasons have anything to do with which asset is fundamentally superior. So here's my thesis on what's actually happening. Bitcoin is digital gold. Actually, it's better than gold because the scarcity is 100% provable, but institutional money managers haven't figured that out yet. So when macro says risk off, they sell Bitcoin like it's the NASDAQ and buy gold like it's 1975. And you know what? That's fine, because every time they do that, they're going to give people who actually understand Bitcoin the opportunity to accumulate at prices that don't reflect the fundamental value. This isn't about Bitcoin failing to be digital gold. It's about Bitcoin being digital gold while being priced like a tech stock. So that's our opportunity. So let's talk about the long game opportunity as well. Because while everyone's looking at these ETF outflows and saying ETFs were supposed to bring stability, but instead they brought more volatility, the experiment has failed, I think they're missing something important. Yes, ETFs made it easier for institutions to panic sell. And yes, that creates short-term volatility. But long-term, this is actually good for Bitcoin. And here's why. In the old model, if you wanted institutional money in Bitcoin, you had to convince pension funds and endowments to set up custody solutions, navigate regulatory uncertainty, explain to their board members why holding this magic internet money was a good idea, and deal with the complexity of actual Bitcoin ownership. It was a huge, huge barrier to entry. And ETFs removed all of that. Now, Bitcoin is as easy to buy as any other stock. And yes, that means it's also easy to sell. But here's the thing, every boom and bust cycle in Bitcoin has the same pattern. That is as follows. A, new infrastructure makes Bitcoin more accessible, which makes the price go up as new money flows in. Then macro conditions change. And the people who don't understand what they bought panic sell, of course. And then the price crashes, of course, and then everyone says Bitcoin is dead. However, people who understand Bitcoin accumulate at lower prices. Bitcoin is on sale for them. And then the cycle repeats at a higher base. We saw this in 2013 with early exchanges. We saw this in 2017 with ICOs and more retail access. Then we saw it again in 2021 with institutional announcements. And now we're seeing it with ETFs. The only difference is each cycle, more people learn. In 2013, it was, what is Bitcoin? In 2017, it was like, okay, it's a thing, but it's just for speculation. And then in 2021, it was like, okay, institutions are interested. Maybe there's something here. And then now, this year, 2026, it's like, okay, institutions are panic selling. Why? Let me understand what I'm actually holding. So we are experiencing the institutions and the institutional funds go through their learning curve. And this is where 62% of ETF inflows being underwater becomes really important, because that's not just a static number. That's potentially millions of people who bought Bitcoin through their advisor, watched it drop 17% on average, and are now asking questions. They're wondering, why did we sell? What exactly is Bitcoin? Is this like gold or tech stock? Should I be worried, or is this an opportunity? And when they start digging for answers, they discover 21 million cap, provable. There will never be more Bitcoin than 21 million. They understand there's no central authority that can print more, that it can't be seized without private keys, so they can become their own bank. Then they understand that the supply is transparent and verifiable with no counterparty risk. And once people understand that, once they verify it for themselves, instead of trusting their money manager, their behavior changes. They stop selling when institutions panic, and they start buying instead. So yes, ETF infrastructure created volatility in the short term, but it's also creating the largest Bitcoin education event in history. 62% of inflows underwater equals 62% of capital that's learning what Bitcoin is. And once you understand what Bitcoin is, once you've been orange pilled, you don't sell it at $70,000 when you bought it at $84,000. You buy more, and you definitely at least hodl. So let's talk about what actually happens from here. Not as a doom and gloom, but as opportunity. Right now, as I was saying, 62% of ETF inflows are underwater. Money that came in at higher prices than Bitcoin is trading today. The average cost basis for ETF inflows, about $84,000. And Bitcoin today, around $70,000. That's a 17% loss for the average dollar that came into ETFs. Now, the bearish take is more selling ahead as people capitulate, and that's a possibility. But the bullish take is, and the one I actually believe, is those people are getting educated right now. Because when you're down 17%, you start asking questions. And when you dig into those questions on why did I buy this? What is this asset actually? And should I sell or should I buy more? You end up discovering this isn't a company that can go bankrupt. This isn't a government bond that can get inflated away. This isn't gold in a vault you have to trust. This is provable, scarce money, programmable money that you can verify yourself. So here's what would accelerate the education. Scenario 1, more volatility, more price drop, more panic, more people forced to actually understand what they own. Scenario 2 would be continued ETF outflows. More institutional selling would equal lower prices, would equal better accumulation opportunities for those who understand. And scenario 3 would be macro staying challenging. If the Fed stays hawkish and geopolitics stay chaotic, this would equal more reasons to hold provably scarce assets like Bitcoin. Now, what would slow down their educational curve? Scenario 1 would be the Fed pivots early. If rates get cut in March or April, risk assets rally, which mean Bitcoin rallies, which means people get bailed out before learning anything. And scenario 2 would be the tech stocks recover. If AI earnings prove ROI and tech stabilizes, Bitcoin rises with it, no lessons learned, which would be good in the short term, but it would also mean that we may experience this kind of ETF institutional sell-off in the long run. And then thirdly would be if we see a major new institutional buyer. If a sovereign wealth fund announces Bitcoin allocation and absorbs all selling, the price would stabilize without the education either. And ironically, the best outcome for Bitcoin long-term is probably more short-term pain, because that's what actually forces people to understand what they own. Now, the next key catalyst to be watching that could affect Bitcoin's price come up on February 11th, where we should be seeing January's CPI inflation data. February 18th, the FOMC minutes will be released. And then on May 15th, of course, Powell's term expires, at which point Warsh may very well get voted in if he gets voted in first through the Senate. So between now and then, we're still in this unknown territory zone. And you know what? On a personal level, I'm okay with that, because every day that Bitcoin trades below its intrinsic value is another day to accumulate. It's another day Bitcoin's on sale. Now, could Bitcoin bounce from here? Absolutely. We saw an 11% bounce on Friday after hitting $60,000. But could it drop more? Also, absolutely. But even if it drops much lower, I don't want to throw numbers out there, it doesn't change the fundamentals. And that's what I want you to take away from today's video. The question isn't, what's the next price move? The question is, do you understand what you're holding, what you're buying? Because if you understand what Bitcoin is intrinsically, it's scarce, with only 21 million Bitcoins ever to be minted. It's immutable, it's non-sovereign, and it's censorship resistant. If you understand these things, then you're not scared right now. So it's just important to realize where we are. We're in the middle of the biggest institutional misunderstanding in Bitcoin's history. But the fact we're even having this conversation, Bitcoin ETFs are approved and are factors and actors in our market, is such an enormous signal for Bitcoin's mass adoption that in itself is a wonderful problem to have. So in conclusion, here's my bottom line on this. I'm not saying Bitcoin isn't digital gold. I'm saying institutions are treating it like it's not. And there's a massive difference. Remember, Bitcoin's fundamental properties have not changed. It's still the only asset in human history with 100% provable scarcity. You can't fake Bitcoin. You can't print more of them. You can verify the exact supply at any moment. And gold, you have to trust assayers. You trust vaults. You have to trust governments saying they have what they claim to have. But Bitcoin, you can verify yourself. That's why we say, and you'll hear it all the time in the Bitcoin crypto space, don't trust, verify. So what's actually happening right now isn't Bitcoin failing to be digital gold. It's institutions failing to understand what Bitcoin is. Bitcoin isn't failing because it stopped being scarce. It isn't failing because the 21 million cap changed. And it isn't failing because the network broke. Bitcoin is failing because institutions with risk mandates and risk mentalities are selling it like it's a tech stock. And here's the thing. When price disconnects from fundamentals, you get opportunities. So yeah, 62% of ETF inflows are underwater right now. That's a fact. Those aren't just dollars though. Those are people or institutions representing people who bought Bitcoin without really understanding what they bought. They bought it through their money managers who treat it like every other position on the Bloomberg terminal. But once the investor, behind the money managers, the actual people whose money is in the ETF start asking questions, that's when things will change. And then as we close out, remember, Bitcoin has been here before. It crashed 80% in 2018, then made new all-time highs. Every cycle, more people understand it. Every cycle, weak hands sell to strong hands. This time, it just happened to be institutions being the weak hands. But they will learn. They're going through their learning curve now. And once they understand what Bitcoin actually is, they won't sell it when the NASDAQ drops. They'll simply be buying more. So that's it for today's video. I hope you gained value. Let me know if you have any questions or have other topics you want me to cover. I'd be so happy to do that for you. And I'll catch you guys here in my video tomorrow.